Taxes are a huge part of real estate investment. Last week, we talked about one of them, stamp duty, which is applicable to both Kenyans and non-Kenyans alike. But there are other tax obligations that you have to keep in mind before starting this investment. Another one being capital gains tax. Once you acquire that property, if you decide to hold it and then resell it at a later stage to make a profit on the difference, you're going to be taxed 15% on that net gain. There's other taxes as well. Assume you decide not to resell it and you want to hold it and make income on that monthly rent that you collect. There's a tax element there too. And that depends on whether it's a residential property or a commercial property. If it's residential and you make between 288,000 to 15 million shillings, then you get to decide if you want to pay 7.5% on the gross rent or pay 30% and deduct all your allowable expenses. If you make more than that and pay 30%, but remember, you can still deduct all the allowable expenses like insurance, agent fees, management fees, etc. The next element that you would have to take into account is VAT. So if you decide to become a registered VAT entity, you would pay 16% taxes, but the onus of that would fall on the tenant, not you. You would just serve as the medium, collecting it from the tenant via rent and then paying that difference to the KRA. As always, make sure you consult a tax expert to make sure that you remain compliant before getting into these financial decisions. And if you live abroad, make sure you consult your tax expert from wherever you're from to make sure that you don't have any double taxation happening. See you next week.